Hello everyone. Today we're going to talk about something that can feel intimidating, but is absolutely essential for your financial security. We are talking about financial statements. Think of them as your personal financial GPS. You wouldn't start a long road trip without a map or a GPS, would you? Of course not. You need to know where you are, where you're going, and how to get there. Financial statements do exactly that for your money, whether it's for a big corporation or your very own household. Many people hear terms like balance sheet or income statement and their eyes glaze over. They think it's just for accountants or Wall Street experts. That is a mistake, a big one. Denying yourself this knowledge is denying yourself power. The power to see if your business is truly profitable. The power to understand if your personal spending is sustainable. This essay will demystify these powerful tools. We will break down the three main financial statements: the balance sheet, the income statement, and the cash flow statement. One step at a time, using simple language you can understand and apply to your own life. The goal here is not to turn you into a certified public accountant overnight. The goal is to empower you. It is to give you the confidence to look at these documents and not feel lost or overwhelmed. We will walk through each component, from assets and liabilities to revenues and expenses. We'll use simple, real-life examples that you can relate to, like running a small coffee shop or managing your own family's budget. By the end of this, you will have a solid foundation. So take a deep breath. Let go of any fear or anxiety you have around this topic. You are smart enough to understand this. You are capable enough to use this information to your advantage. We are going to unlock the secrets of financial statements together, and you will see that they are not secrets at all, but straightforward guides to help you on your journey to financial freedom. Let's begin. The first statement we need to understand is the balance sheet. I want you to think of the balance sheet as a photograph. It is a snapshot, a single picture taken at a specific moment in time. This picture tells you exactly what a company's financial position is at that precise instant. It shows what the company owns, what it owes, and what is left over for the owners. The reason it is called a balance sheet is because it is based on a fundamental equation that must always balance. The equation is simple. Assets equal liabilities plus equity. Imagine you want to open a small bakery. To get started, you buy an oven. That oven is an asset. If you paid for it with a loan from the bank, that loan is a liability. If you paid for it with your own savings, that money is your equity. The value of the oven, asset, is perfectly balanced by where the money came from, the loan or your savings. This principle applies to everything the bakery owns and owes. The balance sheet simply lists all these items neatly so you can see the big picture at a glance. It tells you on this day what your bakery is worth. Understanding this snapshot is critical because it reveals a company's stability. A business with far more assets than liabilities is generally in a strong position. Conversely, a company with heavy liabilities compared to its assets might be in a risky situation, over-leveraged and vulnerable. By looking at a balance sheet, you can assess risk, evaluate strength, and make much smarter decisions, whether you are thinking of investing in a company's stock, lending it money, or even starting a business of your own. Now, let's drill down into the first part of our balance sheet equation: assets. Simply put, an asset is anything of value that a business or an individual owns. It is something that can be used to generate future economic benefit. Think about your own life. Your house is an asset. Your car is an asset. The money in your savings account is an asset. For a business, assets are the resources it uses to operate and make money. This can include everything from cash in the bank to the buildings it operates in. Assets are typically broken down into two main categories: current assets and non-current assets. This distinction is based on how quickly the asset can be converted into cash. Current assets are things that are expected to be used up or turned into cash within 1 year. This includes cash itself, which is the most liquid asset of all. It also includes accounts receivable, which is money owed to you by customers, and inventory, the goods you have on hand to sell. For our bakery example, the flour, sugar, and eggs in the pantry would be inventory, a current asset, because you plan to sell them as cakes and pastries very soon. On the other hand, non-current assets, sometimes called long-term assets, are things that you will own and use for more than 1 year. These are the long-term investments a business makes to operate and grow. This category includes property, plant, and equipment, often abbreviated as PP&E. For our bakery, This would be the storefront you own, the commercial ovens, the mixing machines, and the delivery van. It is so important to have a clear picture of your assets. Why? Because assets are what generate your income. Without ovens, our baker cannot bake cakes. Without a delivery van, they cannot reach more customers. Now we move to the other side of the balance sheet equation: liabilities and equity. Let's start with liabilities. This is a very simple concept. Liabilities are what you owe to others. It is the debt of the company. It represents the claims that outsiders, like banks or suppliers, have on your assets. If you borrowed money to buy an asset, that loan is a liability. In our personal lives, this is our mortgage, our car loan, our student loans, and our credit card balances. These are financial obligations that must be met. Just like assets, liabilities are also split into two categories: current and non-current. The logic is exactly the same. Current liabilities are debts that are due within 1 year. This includes accounts payable, short-term loans, and the portion of a long-term loan that is due within the next 12 months. For our bakery, this would be the bill from the flour supplier that needs to be paid in 30 days. Non-current liabilities, or long-term liabilities, are debts that are not due for more than 1 year. For the bakery, the 5-year loan taken out to buy the expensive commercial ovens would be a non-current liability. Finally, we arrive at equity, also known as owner's equity or shareholder's equity. This is the best part. Equity is what is left over after you subtract total liabilities from total assets. Think about it. Assets minus liabilities equals equity. If your bakery owns assets worth $100,000 and has liabilities of $30,000 in loans, then your equity, your piece of the pie, is $70,000. It is the true measure of what the business is worth to its owners. Growing your equity over time is the ultimate goal. If the balance sheet is a snapshot in time, the income statement is a video. It shows you the financial performance of a company over a period of time, such as a month, a quarter, or a full year. It tells a story of how the business operated during that period. Did it make money or lose money? The income statement is often called the profit and loss or P&L statement because that is exactly what it shows. It answers the most fundamental question for any business. Are we profitable? It is a report card on the company's ability to generate sales, manage expenses, and ultimately, turn a profit. The structure of an income statement is very straightforward and logical. It starts at the top with the total amount of money brought in from sales, which is called revenue. Then it systematically subtracts all the various costs and expenses incurred to generate that revenue. Think of it like a waterfall. You start with the big pool of revenue at the top, and as you go down the statement, you deduct different expenses, and the pool of money gets smaller and smaller. What is left at the very bottom, after all the expenses have been paid, is the famous bottom line, net income. Let's go back to our bakery. The top line of its income statement for the month of July would show the total sales from all the cakes, cookies, and coffees it sold. This is its revenue. From this, it would subtract the cost of goods sold, COGS, the cost of the flour, sugar, eggs, and chocolate used to make those items. What is left is the gross profit. Then it subtracts all the other operating expenses, like employee salaries, rent for the shop, utility bills, and marketing costs. After all of that, you are left with the operating income, a key measure of the bakery's core profitability. Let's look more closely at the two main components of the income statement, revenue and expenses. Revenue, also called sales, is the lifeblood of any company. It is the money that comes in from the primary business activities. For our bakery, that is the money from selling baked goods and beverages. For a car company, it's the money from selling cars. For a lawyer, it is the fees charged for legal services. Revenue is the top line of the income statement because it is the first number you see. Without revenue, a business cannot survive for long. It is the engine that powers everything else. It is important to recognize that revenue is recorded when it is earned, not necessarily when the cash is received. This is a key accounting principle called the accrual basis. For example, if our bakery caters a large wedding and sends the couple a bill for $1,000, that $1,000 is recognized as revenue immediately, even if the couple has 30 days to pay. This provides a more accurate picture of the business's activity during that period. The claim to that cash is now an asset on the balance sheet called accounts receivable, linking the two statements together in a beautiful, logical way. Expenses are the costs incurred to generate that revenue. You have to spend money to make money, and the income statement meticulously tracks this spending. Expenses are generally broken down into several categories to provide more insight. The first is the cost of goods sold, or COGS, which we mentioned earlier. These are the direct costs of creating the product. After gross profit, you have operating expenses. These are the costs required to run the business that are not directly tied to producing a specific product. This includes selling, general and administrative, or SCANDA, expenses. Managing these expenses is just as important as generating revenue. A business that lets its costs spiral out of control will not be profitable no matter how much it sells. We have looked at the snapshot, which is the balance sheet, and the video of profitability, which is the income statement. Now we need to look at the third and final major financial statement, the statement of cash flows. This one might just be the most important of all, because it answers a very simple question. Where did the cash come from and where did it go? Profit on an income statement is not the same as cash in the bank. A company can be profitable on paper, but still go bankrupt because it runs out of cash. This statement tracks the actual movement of cash into and out of the company over a period of time. Why is this so critical? Remember our bakery example, where it recorded $1,000 in revenue for a wedding catering job, but had not received the payment yet? The income statement shows a $1,000 profit before expenses, but the company's bank account has not changed. Now imagine the bakery has to pay its flour supplier $800 in cash that same week. See the problem? It looks profitable, but it could have a serious cash crunch. The statement of cash flows bridges the gap between the income statement and the balance sheet by focusing solely on cash transactions. It reveals the true liquidity of a business. The statement of cash flows is organized into 3 distinct sections, which makes it very easy to understand how a company is generating and using its cash. These 3 sections are cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. By looking at these 3 areas, you can see if a company is generating cash from its core business operations, if it is selling off assets to stay afloat, or if it is borrowing heavily to fund its activities. For your own personal finances, tracking your cash flow is everything. It is called budgeting. You track the cash coming in from your paycheck, which is the inflow, and the cash going out for your rent, groceries, and other bills, which is the outflow. If your cash outflow is consistently higher than your cash inflow, you will go into debt and financial distress, no matter how high your salary is. A positive cash flow allows you to save, invest, and build wealth. The statement of cash flows applies this same essential logic to a business, providing the ultimate reality check on its financial health. Cash, as they say, is king. Let's break down the 3 sections of the cash flow statement because they each tell a unique story. The first, and most important, is cash flow from operating activities. This section shows the cash generated by the company's normal, day-to-day business operations. It starts with the net income from the income statement, and then adjusts for any non-cash items, like depreciation, and changes in working capital, like accounts receivable and inventory. Ideally, a healthy company should generate the majority of its cash flow from its core operations. A strong, positive operating cash flow shows that the business model is sustainable and can fund itself without relying on outside help. The second section is cash flow from investing activities. This part reports the cash used for or generated from a company's investments. This includes the purchase or sale of long-term assets, like property, plant, and equipment. When our bakery buys a new expensive oven for $10,000, that is a $10,000 cash outflow in the investing section. If it later sells an old delivery van for $3,000, that is a $3,000 cash inflow. This section also includes the purchase or sale of securities, like stocks and bonds of other companies. A negative cash flow here is often not a bad sign. It can mean the company is investing heavily in its future growth, which is exactly what you want to see. The third section is cash flow from financing activities. This section shows the cash flow between a company and its owners and creditors. It includes cash inflows from issuing stock or borrowing money from a bank. It also includes cash outflows for paying dividends to shareholders, paying back the principal on debt, or buying back its own stock. If our bakery takes out a $20,000 loan from the bank, that is a $20,000 cash inflow from financing. When it makes a $1,000 principal payment on that loan, that is a $1,000 cash outflow. This section tells you how the company is funding its operations and growth. Is it through debt or by raising money from owners? By analyzing all three sections together, you get a complete picture of the company's cash situation. A healthy company will typically have positive cash flow from operations, which it then uses to fund its negative cash flow from investing, like buying new assets for growth. It might use financing activities to borrow for major expansions or to return money to shareholders. A struggling company, on the other hand, might have negative operating cash flow and be forced to sell off its assets, which would show up as positive investing flow, or borrow heavily, which would show up as positive financing flow, just to cover its day-to-day expenses. This is a major red flag. We have covered a lot of ground today, but I hope you see that these concepts are not as complicated as they first appear. We have demystified the three key financial statements. The balance sheet is a snapshot of what you own and what you owe at a single point in time. The income statement is a video of your profitability over a period, showing your revenues and expenses. And the cash flow statement is the ultimate reality check, tracking the actual cash moving in and out of the business. Together, they form a complete three-dimensional view of a company's financial health, or your own. Understanding these statements is not just an academic exercise, it is a fundamental life skill. It is the key to making informed decisions. Whether you are running a business, investing in the stock market, or managing your own household budget. This knowledge empowers you to look past the headlines and the hype and see the true financial story. It allows you to spot opportunities and, just as importantly, to recognize risks and avoid costly mistakes. You would not let a doctor speak to you in medical jargon you did not understand. You should not let the world of finance do that either. The journey to financial literacy does not end here. What we have done today is lay the foundation. I urge you to continue learning. Pick up a company's annual report, any company you are interested in, and try to read through its financial statements. See if you can identify the assets, liabilities, revenues, and expenses. Look at where its cash is coming from. You will be amazed at how much you can understand with just the basic knowledge you have gained today. The more you practice, the more comfortable and confident you will become. You have the power to take control of your financial destiny. It begins with knowledge. It begins with facing the numbers and understanding what they are telling you. Do not be afraid of it. Embrace it. Use these statements as the tools they are intended to be. Guides to help you build a stronger, more secure financial future for yourself and for your loved ones. You are the person most responsible for your financial well-being. So take these lessons, build on them, and start making your money work for you. You can do this. You have to do this.